Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Marc Chandler, and we're going to be more talking big picture about just this good market environment we are continuing to see. Is the S&P continuing higher at all-time highs? Precious metals, look at gold. Gold is continuing to all-time highs. Silver is even breaking above $33. We also have Bitcoin climbing back towards that $70,000 level. Look across the board, lot of positive moves in markets. Marc is the managing partner at Bannockburn Global ForEx, also editor of the Mark to Market website, which we will post a link in the show notes. Marc, is there a common thread here where investors seem to be piling money into a wide range of assets?
Well, Corey, I kind of think that if there's a common element here, I'd say maybe two common elements. One is this American exceptionalism. I mean, look at what's happening. We're winding down. I should say we're entering Q4. We'll be getting Q3 GDP in a week or so. And the Fed is talking about more than 3% growth. The median in Bloomberg is for 3% growth. So we're looking at another strong quarter. So the resilience of the U.S. economy as Europe is concerned about Germany, the biggest economy in Europe, concerned about another contraction. We've seen some disappointing numbers from Japan. We know that China, despite a GDP number earlier today on the 18th, we know that the Chinese economy is struggling because the Chinese keep giving us new policy initiatives. So I think one thing that stands out is the general sort of American exceptionalism, where the U.S. economy is still like the most dynamic of the major economies. And the second factor I think that these things have in common is I'd say in the past week or so, the U.S. election has become more of a market focus. I know we've been talking about the U.S. election. I mean, it seems like forever. I mean, since the last one, it's almost been a permanent 4-year campaign. But what's changed, I think, is as we get closer to the election, it's still very tight. And I don't want to be very partisan about it, but it does seem that the market, the hedge funds, especially the leverage community, buying, thinking that they want to, that because the election is so close, and this is what I was trying to explain off mic a little bit, is that when it comes in the capital markets, we talk about volatility as being risk. But in politics, risk is something about like a function of credibility and capability. And I think that many people think that Trump, a second term for Trump would shake things up so much that it might not be necessarily good for the U.S., though it could be. It'd be more dangerous and harmful for our U.S. trading partners like Canada and Mexico. And so, sort of partly out of default, I think, and trying to prepare for what looks like a very close election, which we might not even know the results of, within the 24, 48 hours, that this is spurring people, I think about a Trump victory and what it would mean on the regulatory front, on the more encouragement for mergers and acquisitions, hurting our major trading partners to higher tariffs. And so the dollar has got a bid, saying this is the first week in 5 that the U.S. Treasury 10-year yield is slightly lower on the week after rising roughly 50 basis points or so. So we are seeing the markets, it seems to me, things that these have in common is the desire to be long the U.S. against the world.
Well, Mark, also when you see the dynamic where you see the dollar going higher and you see, an interest in bonds and you see an interest in gold, those are typically considered the defensive trades that people get into when there's uncertainty. And there is a lot of uncertainty, but it is weird to see gold and the dollar going up at the same time because typically they're correlated negatively or inversely, I should say. And so do you think there's something else going on with the dollar besides just U.S. exceptionalism? Is there other patterns you see in the currency markets? Because we're seeing gold go up in other currencies too. Or is there something else going on under the surface besides the geopolitics?
But I think that the geopolitics help explain gold too. To me, the important thing about gold is it's not going up for me right now because of so much of uncertainty. This is really a continuation of a move that we've seen pretty steadily this year. And I think that part of this is what's happened, as other people have pointed out too, right, is that since the U.S. Sanctions on Russia, freezing their reserves, not only the U.S., but European countries did the same thing. And I think this has boosted the demand for gold from foreign central banks. And you know who's buying a lot of the gold? The BRICS central banks. And the BRICS have their summit coming up later this month. And so I kind of think that if Trump does put these tariffs on, so play out the scenario, Trump wins, puts out these tariffs, we really end the sort of U.S. defects then from this global managed free trading world that it was so instrumental in bringing. And I think that would really, in the long run, undermine the role of the dollar. But also, you want to be long gold if you're a foreign central bank and you think that Trump could act whimsically, putting on tariffs and whatnot, hurting previous friends of the U.S., talking about, I think this week he was talking about how building cars in Mexico, U.S. companies building cars in Mexico, is a threat to the U.S. So, of course, the Mexican peso sells off. He said that in order for the U.S. to defend Taiwan, they need to pay us more money. And so these kind of things, I think, just bolster the demand for gold, not so much because of uncertainty, but because of certainty. Because certainty, if Trump does this, it will undermine the general role and function of the dollar in the world economy. So yeah, so I'm looking at, broadly speaking, this to be really a question still of geopolitics helping gold. But I agree with you, it's sort of a strange week in which we saw softer U.S. interest rates, a firmer dollar, and gold at record.
So Americans are going to the polls in under 3 weeks. So we will have at least maybe a little bit of clarity behind us in 3 weeks when we chat. Now, again, we might not know who won, depending on just how close that election is. But look back 12 months here, Mark. The S&P is up 11 out of those last 12 months. Gold is up 10 out of the last 12 months. And those dips outside of the S&P's dip that was about 4% 1 month have been very shallow. So even after the election, when we do have some clarity there, what does history tell you about the ability of both of these markets or one of these markets to continue this very strong upward momentum?
Yeah, I don't know. It's hard for me to get my hand around this. Is that well, it seems to me like it's hard to compare the election. So I know that's what a lot of people do. Here's how the dollar performs 3 months ahead of election. Here's how it does in the 3 months after election, and run the same thing through different asset classes. I'm not so sure that it's very helpful, but I do think that in general, the key, and this is why I think it's important to keep an eye on what the big picture is. The big picture is that the U.S. economy is gradually slowing. The Federal Reserve is going to be removing restriction. The Federal Reserve told us in September they're going to cut rates 100 basis points next year. Other central banks have already indicated they too will be cutting interest rates. And and that's really what's happened, I think, in the past week or so. Even though U.S. rates did not rise this week, as I pointed out, the 2-year and the 10-year both lower, rates have fallen sharply in other countries. I'll give you an example: is the German 2-year note. The U.S. had back in mid-September, the U.S. premium had fallen about 135 basis points, and in the last few weeks, we're back up to almost 190 basis points. The Canadian dollar, which has been under a lot of pressure, and part of the story there is Canada discount to the U.S. is almost 100 basis points. That is for two-year borrowings. The Canadian government pays about 100 basis points less than the U.S. That is the biggest discount Canada has offered since 1997. So no wonder the Canadian dollar could be lower even though U.S. rates didn't rise. So I think that to me, this is the key thing is to keep an eye on the big drivers. And the big drivers is the policy mix. And the policy mix is easier monetary policy and probably less easy fiscal policy in Europe and perhaps easy fiscal policy in the U.S., as neither candidate really talks about reducing the deficit, which is something around 6.5% of the U.S. GDP.
Yeah, good point, Mark. I didn't hear either candidate talk about reducing the deficit in any of their talks or debates. So definitely something that's going to be rearing its head, whoever the next administration is. But we're in a weird environment. We've had a couple guests, Mark, that came on our show and said we're really in a market of mixed messages. And that's always kind of true. But in this case, we've heard for years that when the yield curve inverts and then uninverts, that's the prelude to a recession. We've had people calling for a recession for the last 2.5 years. And to your point, we've got really strong GDP, or at least stable GDP growth slated in the 2 to 3% range. So that doesn't really reek of a recession in most people's point of view. But we also have, a situation where we're leaving the last year of a presidential cycle and we're entering the first year of the next administration. Typically, that's a period of time that is going from bullish the last year of a presidential cycle and then bearish the first year of the next term of a new cycle. And then you also still have all of the concerns about rate cuts historically being negative for the market. So make sense of the mixed market and all those market truisms. How do they all stack up as we head into next year?
Yeah, I think for me, part of the challenge is that the economy is not linear in the sense that it's not like the economy grows, gradually slows, and then tips into recession. But it's hard, a quarter before the recession begins often is a strong quarter. But I agree. I mean, this has been a very unusual business cycle. We're going to get in the U.S. leading economic indicators at the start of the new week, and I don't think they've risen for more than 2 years. And so a lot of things that I want to say, like people who have experience in the market, a lot of the heuristic devices and other tools, quantitative tools, haven't been particularly helpful in this cycle. And so that makes it difficult. It makes it difficult for investors, but also policymakers. But I think that there's a common thing here, and that is good parts of the world, I should say, US, Europe, Canada, Australia, Japan. We're moving more or less, right? We emerged from COVID, a big shock. We've had to absorb the shock from Russia's invasion of Ukraine. More recently, we've had to absorb the shocks from the Middle East, the escalation of the war there. We've seen what's happened to oil, very volatile. And so I think that the world, we're trying to make sense of this. And I think that over time, it means that I hate to say this, but maybe inflation really was a transitory phenomenon, and that most of the world, but leaving aside, even Japan actually today had the national CPI numbers; those were lower. Maybe we're seeing this downside of business cycle. Inflation seems to be slowing, and you think about the number of countries. I want to say there's 5 or 6 in Europe that already have inflation below 2%. Canada would be one of them if it was in Europe, but you've got the UK, you've got Sweden, Germany, France, Italy, Spain, all with inflation below 2%. And the UK joined them this week as well. So I think that this is the kind of world that we're living in. And it may be a bit going out on a limb to say this, but before COVID, we were talking about the great moderation, long business cycles, relatively low amplitude, so not like a big move from boom to bust. So longer and flatter business cycles, low inflation, low interest rates. And I think that's the world that we're headed back to. We just need to absorb these shocks. And I think that the global economy is doing a good job at absorbing these shocks. And countries are now giving up the tightening of monetary policy, removing restriction. And next week, we're likely to see Bank of Canada cut by 50 basis points. And we're likely to get another rate cut from China as they cut their loan prime rates, perhaps before the markets open on Monday.
Mark, I find this very interesting because on this weekend show, we're focusing a lot on economic data, big picture, and that ties in with inflation. Not to give too much away from the weekend show, but the commentators there think that inflation is not going to go much lower. If anything, it's going to go back into the 3-4% range. Why are we seeing such a divergence in terms of estimates here? So many people are saying inflation's going to stay high, inflation's going to go sticky, and it's a wide range of reasons that they are giving. Why are you seeing that it's going to be lower? Is it simply because that's what we've seen in these other countries, like you pointed to?
I think partly, so why do I think inflation is going to come off? Partly, I think that the main causes for inflation are not there anymore. And those main causes were really supply disruptions. I think that we've already seen the wages cooling off, not just in the US, but also in Europe. And it's amazing. It's in Japan too. People were excited that the large union organization Ringo in Japan negotiated for a 5% pay increase last year, record pay increase. We all get excited about that. And I think last week they reported labor cash earnings. They were up about 2.4% year over year. So when the union agrees to 5%, that doesn't account for all the workers. So bottom line here, I think that the forces of globalization are still ultimately deflationary. And on top of that, you have the slowing of the world economy, slowing of the U.S. economy. Europe is still is struggling to avoid a recession. The same thing for Canada. So I'm thinking that slower growth. I'm looking also oil prices. Here we are in the middle of perhaps the biggest war in the Middle East in a generation, and oil prices are below $70 a barrel. So what happens when there is a truce? I mean, now that Israel has got the mastermind of the last October 7th strike, sort of their version of bin Laden, Now that he's gone, maybe this gives a better chance to having a ceasefire of some kind. And I can only imagine that oil maybe heads back down $65 or something like that, maybe a bit lower. So bottom line here is I'm just more optimistic that these geopolitical tensions will ease and that we're going to see lower oil prices, lower inflation as the world economy slows. And so for that reason, I'm a bit more optimistic than I'd say than maybe some of the other people you've been talking to.
Well, Mark, we could also look at it that different sectors of the economy are having radically different outcomes. Like if you're in AI, you're on the moon. But if you're in manufacturing, people could have argued that based on the stats, a lot of them below the 50-point readings for the last 2 years, that manufacturing in the US has already been in a recession for 2 years. When you look at real estate, it's a mixed bag. If you look at some of the home builders, they're screaming to new highs. But if you talk to real estate agents and there's not enough inventory, they're kind of in the hurt locker. So again, we kind of have a tale of two cities or a tale of two markets here. I know the October PMI number is getting ready to get released as we look ahead, but when you look at manufacturing, that's also a big thing with the Trump trade, where they're saying he's going to remove regulation. That could be good. How important is it to dissect different segments, like look at healthcare separate than tech, separate than manufacturing, or should we just be lumping them all into the proverbial economy?
I think it depends on what kind of investor you are and what you're investing in. Are you investing in industry sectors? Is that the granular level, looking at companies, sectors, industries? So for me, sort of macro, I'm just looking at things writ large. So I'm interested in the U.S. GDP per se, not necessarily how any individual sector is going. But I agree with you that, the U.S., like Europe, like Japan, like China, large diversified economies. And it's hard to find the key thing for each of them. And especially, we think that, say, for example, interest rates are so important. But it turns out that large businesses in America they're net givers of liquidity. That is, they're putting on deposit at banks more money than they're borrowing, which is a lot different than small and medium-sized businesses. But I agree with you that going forward, that people seem to be optimistic that if Trump wins, there'll be deregulation, maybe help offsetting some of the pressure of the squeeze caused by tariffs, and also antitrust. I think that that's one of the elements of the Chinese reforms that they've recently announced that I think is overlooked. And they're going to be the central bank is going to help finance mergers and acquisitions. And to me, that's a key to addressing the excess capacity issue that they have, the surplus supply. And that's what we do in the US and Europe and Japan. Mergers and acquisitions, industry consolidation and concentration helps alleviate the overproduction threat. And so I see this as a positive sign for China. In the US, I think that people have done some work on with inflation and on how industries are structured. Industries that tend to be oligopolistic, dominated by a couple of businesses, tend to see a bigger price increase than those that had, say, many different, say more competitive industries.
So could that be the perfect storm for these markets to power even higher? A Trump presidency win and central banks, not just in the US, but globally, continuing to ease?
I think so, but I think that the challenge, and this is where I think a lot of the work has really come down to, is assumptions about how other countries respond to, say, a new tariff regime in the U.S. Who retaliates? Will Europe retaliate, or will it only be China? And I think that's, for example, the Peterson Institute. That's what they've come down on, seeing in their work who retaliates, and of course, the more retaliation, the more damage is done. But I think that's what it comes down to: is that anticipating, preparing for Trump victory only because the implications are so much greater, and therefore I think you have to think then if the U.S. does, it's sort of like a big chess game. The U.S. moves a pawn. What will the rest of the world do?
Well, Mark, just kind of tying some of these themes together, we talked about the relentless rise of gold and it's closing this week at an all-time high. A lot of that is from central bank buying. There were some central banks this week that were pretty vocal about why they're adding gold as their second biggest asset on their balance sheet. Mexico, Mongolia, and Czech Republic all came out this week and said that they're happy to be buying gold because of some of the uncertainties they see in the world, but they're also looking at new trade alliances. So all these tariffs kind of tie into how will global trade look, and the BRICS nations meeting this coming weekend, I believe, or next week, again, new trade alliances. So do you think some of this world view as we look forward to the global stage is really preparing for maybe new trade alliances and maybe old trade alliances withering up? How are you looking at that side of international trade?
Yeah, I don't know. I kind of think, Shad, that a lot of this is just like talk. Mexico has had plenty of time to diversify away from the U.S., but they're not. The U.S. still buys something like 90% of everything Mexico sells, if not a little bit more. So I think, in fact, I kind of think in my work, I think that what BRICS are doing is almost replicating the EU strategy. Remember what happened with the EU after the UK joined? They really campaigned to broaden the EU rather than deepen it. By broadening it, I mean including more countries. Deepening it, which sort of refers to coverage of more activities. So by the UK succeeding in broadening the EU rather than deepening it, as the organization grows to more and more members, it becomes less and less governable. So they had to give up unanimity in decision making, and they had to be a qualified majority. When you give up that unanimity in decision making, each country loses a veto. What's happening with BRICS? So if you think about these BRICS, they call themselves one name, BRICS. But really, India and China are going to agree to a common currency? I don't think so. And why would China really be promoting a new, say, BRICS currency when they want to promote the internationalization of its own currency? So I see this BRICS thing as mostly noise and mostly countries sort of enjoying the spotlight. It's easy to say things, make declarations, but I don't think that Mexico is moving outside the U.S. sphere of influence anytime soon, no matter what organization it joins. And I think that we're going to see this, whether it's a Trump victory or a Harris victory, the USMCA gets examined in 2026. And I think the net result is going to be Mexico moves even closer to the U.S. rather than this new trade patterns. But I do think there are some new trade patterns, but sort of really developing what's been around for a while, and that's south to south trade rather than north south trade. But I think this is well underway. I don't see that the dollar has really lost much in doing this. And I really don't think that there's going to be new initiatives really coming out of the BRICS.
All right, Mark, we'll wrap it up here. Man, we covered a lot in this one, but you know what? Big picture themes. Who knows what direction the economy is going in? We're getting a bunch of differing opinions on that. And markets, well, they just keep on plowing higher while also being joined by some of these more safer trades. Does that all reverse after the election, or are there bigger factors at play? It sounds like there are bigger factors at play here, but hey, only time will tell. It's always interesting to hear what you and all our other commentators have to say on what direction everything is going. But hey, at least right now, if you are invested, you should be making money in a number of different sectors. So hopefully, a lot of our listeners are doing that. Again, Marc Chandler, managing partner at Bannockburn Global ForEx, also editor of the Mark II Market website. Mark, it's great chatting with you on Fridays. I hope you have a great weekend.
Thanks. Good luck to everyone.